While Nvidia adds hundreds of billions in market cap in a single day behind closed doors at the Federal Reserve, officials are using a word they haven't used in months. Concern. What if I told you that the very thing making you rich in the stock market, this unstoppable AI rally, is the exact reason the Federal Reserve might be forced to crush your portfolio later this year? Wall Street is celebrating, but the Fed is sounding an alarm that most retail investors are completely ignoring. Nvidia has become more than just a company. It's the heartbeat of the global economy. As it smashes through record highs, it's pulling the entire S&P 500 and NASDAQ along with it. But while the headlines are full of AI revolution and infinite growth, the latest FOMC minutes reveal a chilling reality. The Fed is worried that this irrational exuberance is undoing all their hard work to fight inflation. Today, we're peeling back the curtain on the 3 things the Fed doesn't want you to know about the current AI bubble. By the end of this video, you'll understand why Nvidia's success might be the very thing that prevents the interest rate cuts everyone is praying for. The most shocking part? It has nothing to do with chip sales. We'll get to that shortly. To understand the tension, we have to look at the massive disconnect between Silicon Valley and Washington, D.C. Nvidia recently reported earnings that didn't just beat expectations. They shattered them. We're talking about a company that has seen its valuation triple in a year, reaching heights that rival the GDP of entire nations. This isn't just a tech story. It's a liquidity story. When Nvidia goes up, the wealth effect kicks in. Investors feel richer, they spend more, and financial conditions loosen. Now, look at the Federal Reserve. For 2 years, Jerome Powell has been trying to tighten the screws on the economy. He wants people to spend less to bring inflation down to that magic 2% target. But the AI boom is acting like a massive injection of adrenaline into an economy the Fed is trying to put to sleep. Think of it like a doctor trying to lower a patient's blood pressure while the patient is secretly chugging energy drinks. The latest Fed minutes suggest that several officials are uncertain about how restrictive policy actually is. Given that the stock market is hitting all-time highs every week, they are staring at Nvidia's chart and realizing that as long as the AI hype continues, inflation might never truly go away. This sets the stage for a massive collision between the AI-driven market and the Fed's inflation mandate. The first thing the Fed is terrified of is something called the wealth effect. It's a simple concept with devastating consequences for inflation. When your Nvidia or Microsoft shares go up 50% in a few months, you feel wealthier. Even if you don't sell, that paper wealth changes your behavior. You're more likely to buy a new car, dine out, or book a vacation. In the latest meeting minutes, the Fed noted that financial conditions have eased significantly. That's central bank speak for, the stock market is making our job impossible. If the market keeps rallying, the Fed can't cut rates. In fact, some members even whispered about the possibility of raising SARM's rates again if inflation stalls. Imagine that. Nvidia hits $1,200. And in response, the Fed hikes rates to 6%. That would be a knockout blow to the housing market and small businesses. But here's where it gets even crazier. The Fed might actually hate your portfolio's growth because it creates asset price inflation. They see the AI boom not as a technological miracle, but as a giant pile of dry tinder waiting for an inflationary spark. They are watching the supercore inflation, which excludes housing. And it's staying stubbornly high. Why? Because the people making money in tech are still spending like it's 2021. The Fed knows that to kill inflation, they might have to kill the AI rally first. They won't say it publicly, but the minutes hint that a market correction might actually be a welcome development for their policy goals. Are they actively rooting for a crash? Not exactly, but they certainly aren't going to save the market if it starts to dip. They need the froth to disappear before they can even think about lowering your mortgage rate. The second hidden concern is concentration risk. Wall Street looks healthy on the surface, but if you look under the hood, it's a different story. Nvidia alone has been responsible for a massive chunk of the S&P 500's total gains this year. We are currently seeing the highest level of market concentration in over 50 years, even higher than the dot-com bubble of 1999. The Fed knows that when a market is this top-heavy, it becomes fragile. If Nvidia has one bad quarter, or if the U.S. government places more restrictions on chip exports to China, the entire index could collapse. This creates a systemic risk. The Fed's job is to maintain financial stability. And a market that relies on a single company for its growth is the definition of unstable. Now, this is where things take a turn. It's not just about one company anymore, it's about the AI halo effect. Companies are mentioning AI in their earnings calls just to keep their stock prices afloat, even if they don't have a viable AI product. The Fed sees this as a misallocation of capital. Money is flowing into anything with an AI suffix, while the rest of the economy, the manufacturing, the logistics, the small shops, is starving for credit because interest rates are so high. This creates a two-speed economy, one speed for the AI giants and another for everyone else. The Fed is worried that if the AI bubble pops, it won't just hurt tech investors, it will pull the entire banking system down with it, because so much institutional money is now tied to these few mega-cap stocks. They are trapped. They can't cut rates because the tech sector is too hot, but if they keep rates high, they risk breaking the rest of the economy. It's a lose-lose scenario that they are desperately trying to manage behind the scenes. The third, and perhaps most terrifying thing the Fed is discussing is the neutral rate, or R-star. This is the interest rate that neither stimulates nor slows down the economy. For a decade, we thought this rate was near zero. But the AI boom is changing the math. If AI truly increases productivity as much as Nvidia's Jensen Huang claims, then the economy can handle much higher interest rates without slowing down. To you, that sounds like a good thing, right? Productivity is good. But to the Fed, it means that the restrictive 5.25% rate we have now might not actually be restrictive at all. If AI makes companies more efficient, they can afford to pay higher interest on their loans. This means the Fed might have to keep rates at 5% or 6% permanently, times to keep inflation in check. The most shocking part, this higher for longer regime isn't a temporary delay. It might be the new normal. We've been waiting for a return to the 2% mortgage and the 0% savings account. But the Fed is realizing that as long as the AI revolution is driving growth, those days are gone. In the minutes, they discussed how the long-run equilibrium rate might be higher than previously thought. This is the interest rate illusion. Investors are buying Nvidia today because they think rate cuts are coming to save the economy. But the Fed is looking at Nvidia and thinking, if the economy is this strong, with 5% rates, why would we ever cut? By buying into the AI hype, the market is effectively proving to the Fed that the economy doesn't need lower rates. It's a self-defeating cycle. The more the market rallies on AI news, the less likely a rate cut becomes. You are essentially paying for Nvidia's growth with your own future mortgage rate. So, is this 1999 all over again? Not quite. In 1999, companies had no earnings, just eyeballs and clicks. Nvidia, on the other hand, is printing actual cash. Its profit margins are legendary. However, the Thompson macro and Thompson environment is much more dangerous now. In 1999, the Fed wasn't fighting 40-year high inflation. They had room to maneuver. Today, they don't. Our deep analysis suggests that we are in a policy cul-de-sac. The Fed is boxed in. If they cut rates to help the struggling regional banks and commercial real estate, they risk turning the AI boom into a full-blown hyperinflationary bubble. If they stay the course, they risk a hard landing for everyone not named Nvidia. The data shows that while the Magnificent Seven tech stocks are thriving, interest rate-sensitive sectors like small caps, the Russell 2000, are actually in a bear market. This divergence is unsustainable. Historically, when the gap between the Shang leaders and the cat laggards gets this wide, it's the leaders that eventually fall to meet the laggards, not the other way around. The Fed's warning isn't just about inflation. It's a warning about the structural integrity of the entire financial system. The bottom line is this. Nvidia's record highs are a double-edged sword. They prove that the future of technology is bright. But they also signal to the Federal Reserve that the economy is far from cooled down. The Fed's warning is clear. Do not expect a Fed put to save the market this time. They are more afraid of a 1970s-style inflation resurgence than they are of a 20% drop in the Nasdaq. As an investor, you need to watch the Fed's words more than Nvidia's charts. If the wealth effect continues to run rampant, the Fed will be forced to be the Grinch who stole the AI Christmas. The coming months will be a tug-of-war between AI earnings and FOMC policy. Buckle up, because the volatility is only just beginning. If you found this analysis helpful, make sure to hit that like button and subscribe for more deep dives into the forces moving your money. What do you think? Is the Fed right to be worried? Or is this time truly different because of AI? Let me know in the comments below. I read every single one. Don't forget to turn on notifications so you never miss a market-moving update. Thanks for watching, and I'll see you in the next one.